And we're going. Still not too many people, but that's okay. All right, so just in this quick webinar, well, we'll see how quick it turns out to be. I want to give you guys kind of rundown layout of the option market, and then I'll talk about my interaction with them because I actually have been in the Bitcoin option market for quite a long time now, kind of cheating because I was using European exchanges and they finally kicked me off. But we've got an option market now working in the U.S., just not nearly as advanced as what we had in Europe. So also some of you may be European. I know I've got a decent amount of European subscribers in the crypto service. So I'll talk to you guys as well. I mean, I think you guys have a great lay of the land. So what we'll do is again, we'll talk about the markets that are could say I'm not going to recommend to anybody playing options, but I'll tell you about the markets that are available to us in terms of my experience, so I can at least stand for them being functioning markets. That's number one. And then one thing I'll say is I'll do some talk on strategies and the way I use Bitcoin options personally, but what I would say is I'm not going to do a primer on how options function, convexity as a concept, and gamma. I would go to, again, I put up a link earlier. I would go to our own Leo Valencia's YouTube videos. I put a link earlier in the service to gamma and convexity. You really have to understand that complex concept in terms of options to understand them. So if you're not familiar with options, don't start with jumping into the Bitcoin option market, but take this as a primer. This video will be put on YouTube and put on the site, so you guys can always go back and say, okay, what was he talking about again? Shoot, I might sneeze. Whoops. Excuse me. Oh, sorry. Okay, I'm back. All right, so we'll hopefully you guys have some experience, but you can get through that. So first, I'm going to start with you lucky Europeans because the Deribit.com, DERIBIT, has been around a long time and is a very liquid exchange. It has professional market making, believe it or not, even though it's been basically a decentralized, anonymous exchange for a long time. But it's highly functional. They have an insurance fund for traders that blow up, go bankrupt. You can go down here and say how big their insurance fund is. They have extremely liquid options. Some of the spreads are the best in the market. So in some regards, I look at Deribit as really fair market value for options. I mean, that's a big problem in options, especially when you have something as illiquid as Bitcoin options, is sort of understanding the fair value. So one thing I would suggest that they still let you create an account, even if you're an American, is get an account that will not be verifiable. You can see I got a big red sign, and if I go up here, I've got lots of warning signs that tells me we know you're American, buddy, and you're not allowed here. But I still have my account open. They're not kicking me off in terms of getting the data, and I use that to see this data because I think this is a really good judge of market. And basically, so Deribit is a futures and options exchange, Ether or Bitcoin, and these are the futures, perpetual future, which is like a continuous contract, but you can trade it unlike continuous contracts on the U.S. futures exchanges like E-mini futures, and then some dated contracts, and then you have all these expirations for Bitcoin Bitcoin options. Calls, of course, always on the left, strike price in the middle. And on the right, and then they have the Greeks, some of the Greeks here, but you can add some Greeks somewhere. When you take on a position, they actually show you Vega, Gamma, Theta, all of that. Hopefully you guys understand the basics of that, but if you don't, you have some reading to do. So I would actually suggest, if they'll let you, again, I can still log into mine, getting an account no matter what, just to see the data, so that if you are going to play options on another exchange, an American exchange, which proves illiquid, you at least know some level of reference pricing. If you're able to get an account here and get an account in an American exchange, if you happen to be able to do that through dual citizenship or something else, there are lots of arbitrage opportunities. Huge, okay? So that's something to consider if you're able to, and I have had combos with prop firms that are doing that very thing across the borders, and it's because the pricing can be quite different. Durabit itself is you don't hold any U.S. dollars, you only hold Bitcoin, and so even though this is quoted in U.S. dollars, what they're doing is doing conversion to Bitcoin, and so if you lose the trade, it'll take the amount that you lost P&L wise and multiply that by Bitcoin, and then take that off your Bitcoin balance, which is up here. You can see I have 0.001 left after they kick me off that I'm not able to get out because that's smaller than the increment you can get. So how much is that nowadays? I can do the decimal. That's less than a cup of coffee. So I would suggest looking at it, but be aware of it. But just note how it works. I'll talk about strategies in particular because Durabit, because of the way it's settled, the contract, and because you have futures as an option, you can have some very specialty strategies in regards to how you use it. So it's that amount of margin they give you. What is it, 50x? Is it 50x now, or is it 100x now on the perpetual? Can be used big time and with the combos of option hedges. The other thing I would say that I've learned from Durabit that's really important is one thing that's interesting. So if you're familiar with the term implied volatility, I have been on Durabit long enough to know what is sort of heated volatility versus ripe for reversal. So when the market's very tame and the implied volatility, which is this percentile here at the money. So at the money we're at what, 18,700 or 600 right now. You can see that we're kind of hovering around 87. That's a little heated. So this we're getting a market that's really ripe for reversal for sure. But normally when we get, like, you guys know in the Bitcoin service, I'm tracking the fifth of a fifth for what either is all of our B wave or could be wave one of a larger C wave in the B wave. And I do prefer the latter, meaning we should go to 30 to 40, but we are ripe for a pullback right now. As soon as we finish that fifth, we should see this. If it's normal, I haven't been here in a long time, we should start to see the implied volatility reach about 120. Implied volatility is very interesting in Bitcoin because it's two-sided. So when the market is plummeting, the puts will get heated in implied volatility. Well, both sides will, but particularly the puts. And then call side gets heated when we're running high. And right now we're running high, and you can see both sides are heated, but these call options at 80 are quite tame for saying a top is imminent, but we could easily over the weekend see this reach 120. That's also an important point, is Durabit runs 24/7 like a normal Bitcoin exchange, so these options are always up. Ledger X does too, which we'll talk about, but Ledger X is not a normal Bitcoin exchange. So that's something to be aware of in terms of strategy. Is I've been doing so much more algo work, and I used to have from my friends and I had a bot, a gamma scalping bot on Durabit that was in the works and in test before we got kicked off, which is too bad because the thing was profitable. And so one day I'd love to use Durabit to sort of prime the data a bit more for option edges. But we're just working on other things right now. But that data, that implied volatility is one sign of market reversal, and we're getting hot here at 80, but it typically has had room to about 120 before 110, 120 before it reverses. So that's something to use actually in terms of direction. I'm sure there's something in terms of open interest, getting that. Let me get my fancy cursor on there. I'm sure there's an option. There it is. I'm sure there's an option to use implied or open interest to actually get some edge too as well. I think that Durabit is a more important market than any of our U.S. exchanges for sure. More liquid. It's been around a long time. It's got professional market making. Lots of firms are involved in it, and it's the largest market in the world right now. So this is it. I mean, this is literally the largest Bitcoin market, but Americans cannot use it because of regulations. And Durabit could get approved if they wanted to, but they just haven't. They haven't wanted to deal with U.S. regulation at all. And I say, being European, I mean, most countries work for Durabit. If you're not American, there are a few others. So if you may be from Asia or whatever, you can use this exchange. All right. So that's kind of the world. We'll get into strategies, but that's really kind of the center of the Bitcoin market. When we go to the U.S. market, we've got a couple exchanges. So I've got it over here. My account, this is my demo account, not my real account. They were nice enough to give me an extra one to teach you fine folks. This is Ledger X, and Ledger X is a commodity futures trade commission approved, regulated Bitcoin options exchange for the U.S. In fact, I'm not sure if they even give you an account if you're outside the U.S., but you'll have to ask, look into it. Where the options and the pricing on, I should make one more point here. The options and pricing here on Deribit are 1 Bitcoin based, but you can buy partial. So like you can make a trade for 0.01. I think that's the lowest increment, as I recall. You can get a tenth. So for example, this is 371. So let's do at the money strike here, 18.6. It's saying a call option is 195. You can literally, buy 01 for $1.95. So you can get a real cheap option. Now you start running into commission problems, at some point, but you can do that if you want. Okay. Now Ledger X is set as 1 contract. So here's your strikes for expiring. Is that next week? Because we just expired they have weekly, so the November 20s just expired. So these are your strikes, these are your calls, these are your puts. Now, if I was to say I'm going to click on this contract and buy 1, I'm not buying 1 Bitcoin, I'm buying 0.01. So you can see that it's a 29.40 priced contract, and times 0.01, that's 29.40 for my premium. Okay, so that's how much I'm paying for that contract. So this is really cheap Bitcoin options. It's kind of nice. The only problem here is that they're really illiquid. I mean, you can see the spread here, 24.20 to 29.40. And unfortunately, where in Deribit, if you were to throw the mid in there, multiply the 2 and divide by half, you're very unlikely to get the mid, to be honest. That's a real problem. And we'll talk about how I manage that, because this is where I mostly do my options trading now. And I'll talk about that. It completely changes the strategies I use, unfortunately. Okay. So there's this exchange. They have futures, but this is a non-ledger. Right now they have no margin. So if you buy a future, you are putting up no collateral. If you don't have the cash, you can't buy it. Where all of the options are settled in Bitcoin on Deribit. If you say you had sold a put option here, you would be owning the Bitcoin if it expired in the money, and then you would of course have to have the cash to before they even let you make the trade. And that trade you can see how they have position locked cash in Bitcoin to cover that. The Bitcoin side is for if you have sold a call option, you have to own that Bitcoin, and then if you own dollars, or if you sold put option, you got to have the dollars to cover it. Okay, so there's no leverage on this one like there is in Deribit. They'll allow you to leverage not 100% on the options 100 times like they do on the futures, but they'll let you leverage a certain amount. I can't remember. There's a calculation. You'll have to check it out. It's in the manual there if you're interested. So this is what you have available in trading. The easiest way with Ledger X is you can either wire USD in. It's very easy to get an account. It takes 24 hours. And you don't have to fund it if you don't want to. So if you guys want to play with this, just get an account. It's really easy. As long as you're a U.S. citizen, you just put in like your driver's license. You're done. Typical KYC stuff, and then it takes about 24 hours to prove on a business day. And then you can at least get familiar with what's going on here. So you can deposit here and whatnot. Now, one thing I would say is if you are starting with cash, and you buy if you say buy Bitcoin, and you say you put 1. So if I put 1 contract of Bitcoin, it's $186 because it's 1% of that. Again, it's a 0.01 Bitcoin. You can't sell a call option on that until it expires, because this is essentially a swap contract, which is sort of that's a weird contract. But at 4 o'clock Eastern time, that contract will expire, so you actually have the Bitcoin, and then you can also then sell a call option on it. Okay, so because assuming that you understand options, 1 Bitcoin will cover a short call option. So just so you know that, so you got to wait till that swap contract expires, and then they settle it as Bitcoin in your account. And then that's when you can also send the Bitcoin out of your account if you want to send that Bitcoin to say Kraken or somewhere else to trade that Bitcoin. So that's how this works. And then the futures contracts are kind of interesting because there are different prices, and there's honestly an arbitrage opportunity between the spot price, which is the swap contract, and the futures. But right now you can't own that and sell that. So, but I do a lot of chats with these people, and that's something that they're looking at in terms of approval. Although I assume as soon as we see that, you can see the mispricing slightly in the bid and ask over here and the bid and ask over here. You can imagine one thing. I don't think it's liquid enough to arbitrage, but at some point in time, we may actually be able to do that, and it would be fun to have a bot that was doing that for us. So that's something to watch for if they start to enable. I know they've talking about portfolio margin, which will allow you to do some interesting things like spreads, but that is not enabled on this whatsoever at this point in time. Okay, so that's Ledger X. This is where I do most of my trades. I had just opened a TradeStation Futures Plus account. I am trading on my other TradeStation Futures account with some bots. I really like TradeStation for its algo capability. That's why I got it. And I got this account, this TradeStation Futures account. This is an unfunded account for me, but at some point I will. But this is the CME, the Chicago Mercantile Exchange Bitcoin Futures options. Okay. As far as I can tell, on if you're Interactive Brokers, which has been my longtime broker, you can get the futures contracts, but you can't get the futures options, which is interesting. I don't know why. And I would be really sad to find out that TradeStation was giving me this quote and then not letting me trade it. I assume I can trade this since it's here getting quoted on my account, but I haven't funded and tried it and tried a trade at this point in time. This is a lot more liquid here, but here's the thing about these futures contracts. This is a 5 Bitcoin contract. So what are we at? 18,000 right now. This is nearly $100,000 worth of Bitcoin per futures contract, and the futures contract is what is it? I think it's 40% collateralized. So we're talking about $40,000 right now to collateralize one futures contract. In terms, I think that's right. You'll have to verify in Bitcoin futures. Now the options, the only time that margin matters is if you're shorting the options. So I can short a put options, and I've got to have that margin minus plus what's in the money basically. So it's a little different from Ledger X, where you really have to have the full cash, but still that's an awful lot of cash. But if it works anything like normal CME options, you can spread it. So if I was to say sold a put at 18,800 and then bought a put at 18,600, for instance, I would be short put option, but I would only have $200 in margin risk. So 200 times 5, so that'd be $1,000 in margin risk. So that's the nice thing about this. Again, I haven't tested to make sure, but I trade ES futures, other CME futures. Option spreads all the time, and that's how the margin works. So I'm just preempting that based on it functioning like any other CME futures. So that's an option. And so all of a sudden, if we look at this quote here, so man, I have to say these prices are so heated already. I don't have implied volatility. Oh, it is up there, 76. Yeah, we're starting to see some heated implied volatility here in Bitcoin, which says the top is coming. But so we have a spread. I assume since they have professional market making in CME that we can get a mid price here. So there's a $100 spread here, which literally is $500 difference times that 5 Bitcoin contract. But I assume we can get that mid price pretty easily. So I haven't tried it yet. Again, I'm interested to try this contract. But I would assume that would be the case, and that would be fine if you get the mid price and you get the mid price going out. It seems to be pretty constant, $75 to $100 spread, and as long as it stays pretty constant for the most part, I would assume that you can get that mid price. I'm sure there's gonna be times of liquidity where it's challenging, but you can see, you can see that, like for instance, let's say $100 for a $200 spread, for instance. So that would be about $1,000 for a $200 spread, and with a am I getting this right? 2,000 payout. I might be doing my math wrong, but you get the point. So there is, reasonably sized players can do spreads on this, but you got to be pretty large to go short options, even just to go long right now. I mean, even a few days ago, this was like a $1,500 contract total, and right now it's 4x that. So implied volatility has grown immensely over the last over the last, and I was saying at the money, well, we were lower too, but when I last looked, but I think it was last week and a half, this contract price, just looking at this at the money call option, has basically moved by 4 times, which is incredible change in implied volatility. So that's the other thing about trading options. You got to understand whether you're in a cheap regime and or an expensive regime. And again, if you want to buy options in Bitcoin, you kind of want to be around the 50 to 60 implied volatility, and you want to tend to sell Bitcoin options as you get over really 80 implied volatility to 120 volatility. That's kind of my rule of thumb in terms of experience on Durabit. Okay, so that's kind of the lay of the land. Oh, lastly, skew trading. Skew is really interesting. Skew.com. This is an interesting site. They do a lot of analytics for free on futures and options. Let's see. So you can go peruse all of their data on. They even include Durabit and BitMEX futures and Kraken. What's going on in all of this Bitcoin world. So at some point, I may get an account and just peruse the data to find edges, but I really need a bot machine learning to programmed up to do that stuff. But they also quote the CME futures options and allow you to open a trading account. I have no idea what that trading account entails, but if you don't have a TradeStation account, this is a decent way to get a 15-minute delayed quote on the CME futures. I'm even seeing both CME futures options and Durabit options are pretty liquid, but I'm seeing a difference in quoting, which is interesting. There could be there's plenty of volume to arbitrage the two, which is kind of interesting. Again, if you are not a U.S. citizen or have or somehow a part of a non-U.S. firm or something like that, you could potentially arbitrage the two, which is really interesting. You just have to realize that in CME you're talking about a dollar settled options. And then in Durabit, you're talking about a Bitcoin settled option. So you have to manage that as part of your arbitrage. Like, it's a little complex. But I'm going to take a stop there before I talk strategy approach, the way I have approached these exchanges. But any questions about the lay of the land? Durabit will not let me create an account based off IP, which we'll try later. VPN. Yeah, you probably can get one with VPN. I created my account under VPN, but they tunneled it. So they may tunnel it on the spot or tunnel it later. But again, they tunneled mine and they haven't kicked me off. They just won't let me put any Bitcoin on there anymore. Any other questions about the lay of the land? Like, I gave you kind of the lay of the main options, exchanges and locales and the difference. I mean, again, note the differences in settlement. LedgerX is cash for puts and Bitcoin for calls. It's a 1% contract. Durabit is a one Bitcoin contract, but you can cut it down. And then CME is just plain 5 Bitcoin. So it's a big contract, lots of margin required for that. So you have to be aware. But you can get access to it with some normal brokers, and apparently TradeStation at least quotes it for me, and I'll have to see when I get around to funding that and trading it. And I'll report back if it doesn't. So, all right, so I go on a strategy. There's no questions, and then you guys can ask questions. So the first strategy, we'll use Durabit, but it's this one really can work on any exchanges. The good old collar strategy. And again, if you're not familiar with the collar, then I would look it up. I mean, you can obviously do put protected Bitcoin, and so what I would suggest if you're new to options is use a safe route and use a strategy that's not going to lose your shirt by burning premium or killing your Bitcoin holdings, or worse, blowing you up. So the good old collar strategy is a very simple way to manage Bitcoin holdings and hedging. And I would say I wouldn't be buying protected puts right now, but doing a collar strategy works because you can offset some of the implied volatility. You just have to realize that when you put on a collar, you do have a limited upside for a period of time. So I'll just use a document to show. What's a collar? So it's very simple. You own Bitcoin, you sell a call. And so let's say you own Bitcoin and you sold a call for 20,000. That means you're not going to make any more money than 20,000 until expiration. And when expiration goes, then your P&L is free. And then you own a put. And so you might say, okay, well, I'm going to protect one put. Doesn't like, yeah, okay. And let's just say I'll protect myself down to 13,000, so I'll use that strike price. Okay, so that's an example of limiting your upside and limiting your downside, so you're kind of protecting your investment in your Bitcoin. So if you owned one Bitcoin, you'd have to trade 100 contracts in LedgerX, one contract in Deribit, and you're not even touching BTC. If you've got 5 Bitcoin, you'd want to trade 500 contracts in Ledger, 5 contracts in Deribit, and 1 contract in CME. So you just have to know the calculations, but that's a way to protect your investment. The one thing is, one point I want to make about this, especially when implied volatility is high, this strike price is closer than this strike price to current price. This one is 2,000 up, this 5,000 down, and that's simply because I can probably get more for this contract than I can for the purchase of this contract. Okay, that will allow me to actually get the trade on a credit. So while I'm going to lose some P&L potential here, at least that the trade doesn't cost me anything. So I recommend that strategy when implied volatility is high. There's nothing wrong with hedging when it's low, but when implied volatility is low, you may want to not ever use that call because the upside. Right now we're getting heady. It's obvious that we're getting to a point where the market can top potentially. Again, until support is broken, there's no top, but we're getting heady in terms of the implied volatility, the sentiment out there, and then the Elliott wave count is sort of running to a short-term completion at least, and emphasize short-term right now until we know more. And so you would want to use this sort of strategy in that situation to help pay for the put. You don't want to just buy an expensive put and then have Bitcoin continue to fly and that just becomes a drain. You kind of want to basically use the price of the call. And what's nice about Bitcoin is because it's got upside implied volatility, where again S&P 500 loses some implied volatility while it's running high. Calls are always cheap in the SPX. That's not the case in Bitcoin. Those calls can get really expensive on the top because everyone's chasing. So you just don't see that in S&P 500. You do see that in gold. So that's something to consider. It's a great strategy for hedging. You just have to be aware of what you are giving up in terms of risk, and that really is that Bitcoin runs through 20,000, and all you capture is say the last $2,000. So you just have to be aware of that. And if you want to just buy that put, well, the problem is just buying the put is you're paying a lot for it. So that's just a reality. The trade-off that you have to understand. And there's one modification I like to do here is 230. I like to do, and most of my hedging strategies like to use 30 delta puts. Okay, and I like to use 2 because I can make a ton of money if the market starts to puke. So if it happens to turn around on me, I have two delta puts. At some point in time, if you understand convexity, those 30 deltas can each turn into 1 delta, and pretty soon I'm short 2 Bitcoin on the way down because this 30 delta swelled into, let's just say it just goes 60 delta each. I'm basically short 1.2 Bitcoin. If you understand option delta is how much it's leveraging. Every 100 is 1 of the underlying, so 30 deltas would be 30% of the underlying, and gamma will pump that up. The gamma is the convexity. It's the kind of convexity Greek of the put. So that's a strategy. If you understand options, understand what I'm talking about. So this is something, even in my S&P 500 hedging, I like to sell 1 call and I like to buy 2 puts that are out of the money. Get the puts as cheap as possible, get them paid for by the call, and then when the crap hits the fan, those things swell in value. Okay, sometimes you get the benefit of that, and sometimes you don't. But it's dealing with that uncertainty in markets. So you would, if you go over here to Deribit, we'll just use this easy example. We're at 18. We would sell the 20,000 call for. We might be able to get about 280 here because we've got a spread of 270 to 288. Sell one of those, and then we go way down here. Let's see, where's my delta? Delta is over on the side. Let me nudge this over. Let's see, 0.3, so it would be somewhere in between ideally, but we would buy that puts us in the 18. That's funny. It's 20, and then why are they saying, it's just slightly outside the money. I would want to do the 17.5 in the situation, not the 13, but so 2 of those would be That's still upside down in terms of value. So it doesn't quite work out. So I would want to get 280, and then I would want to pay. I want to buy these under 280. So I would end up, unfortunately, here buying the 16.5. Okay, because I can get 2 of those less than the value of the put call I sold. Okay, so it doesn't work perfectly like it often does in S&P 500 for me, but that would be what I would do. So that would be a collar strategy, and then again the option of collar strategy with the extra put, but more out of the money, would work quite well. So that's one option. Another thing you could do, which does not work at this timing, again because it's implied volatility is way too expensive. But when implied volatility is cheap, and again down at the 50 level, 60 level, it starts to become reasonable. And you're a long-term bull like I am in Bitcoin. I mean, I see everyone's criticized me for thinking we're in a B wave. That's fine. My stop system will keep me in if I'm wrong anyway, so I'm not worried about it. But you can hedge, and this is a strategy I use fairly often. And you can just simply buy one put, and let's just say you buy 50 deltas, which would mean it's at the money, and then you would buy 0.5 Bitcoin, okay? And this is a neutral position. I mean, or let's just say you want to do 1 Bitcoin, so you have a half hedge position. Why is this half hedge? Because you have 50 deltas, which is worth half an underlying, and then you have 1 Bitcoin. So this is half hedge. But then as the market drops, okay, you all of a sudden have more deltas here. So you would, let's say all of a sudden the market drops and you have 70 deltas. Well, then I would want to scalp that by taking my Bitcoin position up to 1.2 to maintain that half underlying. Okay, so if I have 70 deltas here, and then I have let's do it this way, 1.2. Now all of a sudden I'm back neutralized. Whoops, sorry, I'm clumsy right now. I'm back neutralized to that 0.5 underlying. Okay, I'm gonna do that again. So let's say we are 1 put that's 50 deltas, and we're 1 Bitcoin. Okay, and the market drops. Suddenly this goes to 70 delta, just as an example, and then it's in profit too. Your put's in profit, but I want to maintain that half underlying, so I'm going to up this to 1.2 Bitcoin. Okay, so what this does in effect, and then let's say we increase, let's say the market goes back up, this goes back to delta, and then we want to drop that 0.2 Bitcoin off the market, but at a profit because we went up, and all of a sudden this put option put you into a forced scalping, hedged scalp, in, out, at a profit. And so you're basically, you can end up, I mean, Bitcoin moves so fast, you can end up doing potentially some of these several times a day. And this is often the way I trade. So, I'll hedge a certain portion of my exposure, and then like Kraken, I use leverage, and then I'll be looking over at my Ledger X account and say, okay, I'm hedged up to this point. You know what? I don't like that put hedge. I'm gonna put on some more Bitcoin out of leverage. Now, you got to be very careful because, for me, if I'm using one account to trade, I have no protection for my leverage over at Kraken when I've got puts over at Ledger X. It's a lot better if you're over here at Durbit, you're owning a put option and you're trading their 100x leverage futures, but never ever getting anywhere close to that amount of leverage. So you're never at risk of breaking the bank. You have a lot of room to cover what happened. You can also put some limit sales on your puts that will actually give you money in your account if there is an ultimate breakdown. Okay, so if you do that with, say, between Ledger X and you do that and Kraken, you've got to really have some stops on in case know where your margin breaks and where you start to get margin calls. So that's a strategy where you use a partial hedge, and you basically use the leverage to sort of add and scalp against that hedged position live. But again, if you want to do this works with high implied volatility because you're selling high implied volatility to buy high implied volatility. Here, you don't have anything to sell, any options to sell, so you really can only do this, put on this put when implied volatility is quite low. If the market was to climb in this kind of position, I would want to sell calls to to start to capture that high implied volatility. So you can convert this position. So this is the caller, and I would call this as kind of I'm going to call this kind of a long gamma scalp, because this is gamma scalping, but gamma scalping I'll talk about in a second, which is really using straddles. It's sort of a long only gamma scalp, which is basically the gamma is basically adjusting your delta position using that option convexity, and you're basically scalping it off by going long. I don't see any reason to do this on the short side, meaning own a call and sell Bitcoin. There's no reason to do that, because Bitcoin has this way of coming down really fast and then going right back up over a period of, sometimes it takes months, sometimes it takes a few hours. So it is just a bad strategy from my experience with Bitcoin to use the opposite, which is owning a call and shorting Bitcoin. I mean, just don't short Bitcoin on a regular basis. Short some altcoins. They do a great job of putting more Bitcoin in our account. There's lots of opportunities for shorting altcoins to earn Bitcoin, which is a strategy I've talked about a lot in the service. So that's an interesting strategy. And then lastly is the true gamma scalp, which is I had a gamma scalp bot. It's hard to do. This is when you're owning a put in a one call, basically a straddle at the money. At the money has the most gamma, and basically, the market goes down, the put's going to have more delta right now. So if you put that both on exactly at the money, you're basically market neutral, meaning you get no return from the market. But if the market moves, then if it moves down, the put will become more valuable and have more deltas. The call will lose its deltas. Again, that's back to convexity. And then if the market goes down, you would buy Bitcoin. If you go up, you would short Bitcoin. We had a bot that was being tested on Durabit to do this gamma scalping. And sometimes we would vary the delta, like meaning give it somewhat of a variation like this, where one side would be a little bit more deltas. Like if we want it to be long, usually that's long. And so it would make money. And so it's a strategy that can make money as long as you're buying that implied volatility for both the call and the put near the 50 or 60 deltas, 50 or 60 implied volatility, and not buying what we're seeing right now, which is 80. And 80 and above, you're just going to lose your shirt on long options. Of course, there are a lot of options, for just going long gamma. You can Durabit. You can say, okay, I'm gonna, just like spreads in, Bitcoin's going to go up, and you can say I'm going to buy the 18.5 for $225 roughly, and then sell the 18.875 for whatever. Here we have a probably price about 60 in the middle. Okay, so you could certainly do normal vanilla spreads. There's no problem with that. And certainly that strategy is reasonable even when buying implied volatility is long, because at least you're buying heavy and selling heavy, but it's not as fruitful as if you can get that cheap. Obviously out of the money calls. Now what I'm going to say is on Ledger X, it's impossible. Where's my Ledger X? Down here. These spreads, unfortunately, are too big, and this is where I usually trade. So when I'm on Ledger X, where's my I had to put it on Firefox. Some other one has my regular account. When I'm on Ledger X, I keep a short option focus, because the spreads make it really hard to get in and out. I don't want to be long gamma on this most of the time, unless I'm doing that hedging gamma, that long only gamma scalping strategy, which I shared with you. Most of the time I'm selling, so I'm using it as a hedge. I definitely want to be selling those calls before I buy any puts. You can see a spread, just look at this, like, for instance, next week, 14K, the spread is $600, and getting that mid, which is about 4,500, is very, very difficult. Now, the only thing I would say is if you go over here and see a certain price over here, and you can, let's say cross the spread, which happens, and you can cross the spread over here, then it becomes a little bit worth it. But there's always the risk that the bid isn't there when you sell that option. That's the problem over here. And so I like to stay as much as possible in shorting options, because I don't have to worry about getting out. They expire, and I'm not blowing up because there's no leverage involved here. If I own that call, and then if I'm doing a hedging strategy like what I shared earlier, then I'm doing that over at Kraken. I'm doing the call side, and then if I need to bolster this account or bolster that account, I can always move funds from Ledger X over to Kraken, or vice versa. Now, just note that funds can only be moved from Ledger X at 4 Eastern time on weekdays, unfortunately, because they literally call you for a security call before they send that Bitcoin out. So that's one problem. But again, I stay within my leverage means to make sure I don't blow up. Okay, so that's just the one thing I would say about LedgerX. I know they are trying to get professional market maker. I've chatted with the CEO in the chat box. They're trying to get portfolio margin, which would help market makers come on board and all of that stuff, but they haven't been approved for that. So that's in the works, but I have to say they've been very, very slow. I like where they're going as a company. I like the simplicity of the interface, but the liquidity is just, it just isn't there. I mean, it's pretty bad. I mean, you can see it. So for me, the way I manage it is I try to stay on the sell side on this exchange, because I don't lose money if I sold something for money, and then I don't lose, I can lose Bitcoin in the process, but I can't lose any cash in the process if I'm selling something out of the money and getting some premium for it. I just may or may not get a great price for that premium. So I think that's again, hopefully you understand these strategies. I mean, again, hedging your Bitcoin, it helps you get through the volatility of this market. It's consistent. I mean, this is a really good strategy if you're careful with your margin side. You can always do this without margin, but it's a little less effective. But if you wanted to just deploy cash against your put deltas, certainly just using cash will keep you super safe in this strategy. And then you're scalping Bitcoin. What the risk in both of the scalping strategies is that you're not short any gamma, so that means you have no positive theta, you have no time decay in your benefit, you are basically draining. So any scalping you're doing, you're trying to outrun you're really trying to outrun your theta, which when we had a bot, it was really easy. In real life, I sure like this strategy a lot better, because this strategy is just more time burn that you have to fight against, and this one's quite simple in terms of just managing your delta exposure on your put against your underlying value. There are if you type in gamma scalping, if you don't understand this concept, gamma scalping, there's a few write-ups on the internet. I would just, the warning I would say is about gamma scalping is when you start to understand it, you start to think about it as free money, and it really isn't. You really got to be on top of your scalping. You still got to add a little element of timing, technical analysis for when you put on your scalps against, like if Bitcoin's falling, I don't I use Elliott wave to see where the fifth wave completes before I end up managing my deltas. I want to buy that Bitcoin super low, and then then I'm more likely to get a reversal of some kind to take some of that off profitably. So and then at some point, you just have a better advantage of just selling that put at a profit if you really took a nosedive, and then putting one on lower potentially when the implied volatility shrinks back. So that's fairly complex, but it's fairly complex if you're new to options. But if you know what I'm talking about, if you're familiar, and if you're not familiar with gamma scalping, I would look it up. Again, I in tests, real live bot, we're profitable, so it was a pretty cool strategy. But you have to really be on top of your scalping. All right. That's mainly all I want to say. I mean, kind of lay of the land. I mean, is there any questions about my strategies, or go back to the lay of the land? I mean, where the markets are, whether Europeans or Americans can access it, what you can access, contract terms. Again, I went over those, Durabit, CME, and then in LedgerX. I don't see a lot of questions. I mean, I have to say, like, especially guys on crypto, like I think learning this is good as long as you understand what will blow you up. You're not going to get blown up on LedgerX, but you could get trapped in bad spreads for sure. And I have, when I first started trading there. That's just what you need to know. It's kind of hard to blow up in Durabit unless you're really like margining yourself out, because they give you so much margin. It really is hard to blow up, but I've seen people blow up on Durabit. I think in my early days, I did, not understanding Bitcoin volatility so much, and then leveraging too much. But by the time I was trading on there, I was using like 3x tops, not 100x. Well, I never used 100x, but I was getting closer to that level, and it wasn't blowing up at all. Of course, we have 5x leverage on Kraken for Americans, and that can be blown up if you're over leveraged. But I tend to stay closer to 1 personally, 1x in most of my leverage trades. Sometimes it gets to 2, but it's really rare. because I don't want to blow up. So any questions about strategy, how you can use this, current state of the market in terms of implied volatility. I mean, I talked about that. Implied volatility is really expensive, and that can often point us to a top. Of course, those that are familiar with my Elliott wave counts, I do expect a short-term top coming in, but we got to break some support first. Right now, that's 17.1, so we got some room to go higher, and we should go higher over the weekend. All right, I don't see a whole lot of questions. I will. If you have some more, you can ask me on the board. I'm happy to answer it, and then I will get this recording up. And I wish everyone a happy weekend. And for crypto folks, our webinar, our weekly webinar is tomorrow and early morning as usual. And we'll see you then. So I'll talk to you guys later.